Silver didn't just spike, it almost broke the market. In a matter of hours, the price went vertical. Calm overnight trading around $108 to $111 an ounce. Then an explosion. Silver ripped to roughly 117.84 intraday, up more than $13 in a single session, the largest one-day surge since March 1985. And then just as violently, it reversed. Nearly $10 wiped out before traders could even process what they were watching. This is the contradiction most people miss. That move wasn't pure strength. And it wasn't failure either. It was pressure being released and rebuilt at the same time. If you think this is just a chart anomaly or a trader story, it already affects you. Volatility like this doesn't stay in metals. It bleeds into currencies, into confidence, into what your money actually buys. But here's the part nobody is saying out loud. Markets don't behave like this unless something underneath is being forced. And the reversal near 117 may be the clearest signal of what's coming next. What happened on that day looks dramatic on its own, but it only makes sense when you stop treating it as a single event. Silver didn't wake up on January 26th and randomly decide to move 15%. The market had been climbing for months, almost without interruption. 9 straight months of gains. Prices holding steady overnight, almost unnaturally calm, before volume suddenly surged and the price went vertical. That sequence matters. Stability first, then acceleration, then exhaustion. This is where the framing changes. This wasn't just a rally reaching a peak. It was a market testing its own limits in real time. Notice how little information most people focus on. They see the high, they see the drop, they argue about whether it's bullish or bearish, but they ignore the pattern forming underneath, where momentum and fragility exist simultaneously. Here's the question that reframes everything. If this move was healthy, why did it need to reverse so violently? And if it was unhealthy, why did it get that far in the first place? That tension is the real story, and it points to forces much larger than silver itself. Now watch how the first hard evidence starts to surface. The strongest claim here is simple, and it's uncomfortable. This move showed exhaustion, not collapse. The evidence is mechanical. During the surge, short-term momentum indicators didn't just heat up, they maxed out. On the 4-hour chart, relative strength pushed to roughly 87. That's not normal acceleration. That's extreme overbought territory. Historically, readings like that don't signal strength continuing smoothly. They signal stress, a rubber band pulled too far. And look at how the price behaved. Silver didn't grind higher. It jumped. Overnight stability around 108 to 111. Then, on heavy volume, a near vertical launch toward 117.84. That kind of structure matters. When price and volume spike together, it tells you leverage is involved. Aggressive positioning, traders piling in late. Then came the other side of the trade. As price hit that zone, selling didn't trickle in. It slammed. Nearly $10 erased from the highs in hours, also on heavy volume. That tells you this wasn't panic selling by long-term holders. It was positions being unwound. Now notice what's missing. There was no slow distribution, no gradual topping, just speed in both directions. That's not the behavior of a calm market, that's a market hitting a limit. And that limit didn't appear by accident. Once a market starts moving like this, it doesn't quietly slow down. It escalates. The silver rally didn't just stretch higher, it went vertical, and that matters because vertical moves erase structure. There are no clean support levels, no orderly pauses. Price jumps so fast that normal trend lines stop working. That's why analysts were forced to step back and look at much longer time frames, even logarithmic charts, just to understand where this move was colliding with history. When you do that, something jumps out. The current price zone lines up with a long-term resistance that connects the 1974 peak and the 2011 high. Different decades, different crises, same psychological ceiling, around the 117 to 120 range. Here's why that comparison matters. In past cycles, when silver approached these levels, it didn't gently consolidate. It either broke decisively or snapped back hard. And the longer the run-up beforehand, the more violent the reaction. Now watch how fast something abnormal becomes normal. 9 consecutive months of gains, a 15% intraday spike, a $10 reversal treated as routine. That's escalation through normalization. And once markets normalize instability, the next phase doesn't de-escalate. It intensifies. The second proof is more unsettling because it exposes a contradiction most people don't want to see. While the price action looked explosive, the real engine wasn't physical silver changing hands. It was paper, futures, ETFs, leveraged vehicles that magnify both greed and fear. Products like SLV and mining ETFs surged as traders chased momentum, not metal. That distinction matters because paper can be sold instantly. Physical silver rarely is. At the same time, the system quietly tightened the screws. Margin requirements were raised. The cost of holding leverage positions increased overnight. That's not a neutral change. It forces weaker hands out of the trade, regardless of conviction. Now layer this on top. As long positions rushed in late, short sellers were already trapped. Some were sitting on massive unrealized losses, effectively becoming future buyers if price kept rising. That's how squeezes form. But here's the contradiction. Just as shorts were under pressure, longs were suddenly incentivized to take profits. So you get both forces colliding, shorts covering into strength, longs selling into resistance. Here's the line that changes how you see it. This wasn't bulls versus bears, it was leverage versus reality. And when leverage dominates a move, the reversal is never gentle. After that collision, the situation didn't stabilize, it stacked. First, volatility itself became a driver. Rapid price swings forced liquidations, not because traders changed their minds, but because risk systems did it for them. Positions closed automatically, speed replaced judgment. Second, institutional voices moved in the opposite direction of the chart. Bearish forecasts surfaced almost immediately, calling the rally unsustainable and predicting dramatic downside later in the year. That disconnect matters. When prices surge while official narratives turn colder, uncertainty accelerates. Third, correlations started breaking. Silver was still elevated, but other metals began to roll over. Sharp reversals appeared elsewhere in the complex, signaling a broader liquidity event rather than a silver-only story. None of these developments on their own would be destabilizing. Together, they compress time. Decisions get rushed, mistakes compound. This is what loss of control looks like in markets. Not a crash, not a top, but a system reacting faster than participants can think. And the question that follows isn't whether this move was justified. It's what happens if this continues. At this point, it stops being abstract. This is where it reaches you. When silver moves $10 in hours, that volatility doesn't stay locked inside a trading screen. It ripples outward. Currency traders adjust, import costs shift, hedging strategies break, and slowly, quietly, it feeds into the prices you actually pay. If you hold cash, swings like this change what that cash can buy. If you save, they change the rules of what feels safe. If you don't own metals at all, it still matters because markets like silver are pressure valves. When they shake, it's usually because something else is under strain. Notice how fast expectations reset. A move from 117 back toward 108 isn't treated as a collapse. It's treated as normal. Even a drop to 100 is framed as a healthy pullback. That mindset is important. It tells you people aren't panicking. They're adapting. And adaptation is how instability becomes lived reality. Not through headlines, but through acceptance. If this feels familiar, say so in the comments. Because what looks like a wild commodity move is really about something deeper shifting beneath everyday life. And that brings us to the mechanism that allows all of this to happen. The mechanism isn't chaos, it's structure. Capital moves according to incentives, and right now, the incentives are warped. When confidence in complex assets fades, money doesn't disappear. It looks for simplicity. Liquidity flows down the risk ladder, away from promises and toward things that don't rely on counterparties. This is where silver's size becomes the story. It's not a large market. Annual production is roughly 1 billion ounces. Even at elevated prices, that's a tiny pool compared to the oceans of global liquidity looking for shelter. When large systems try to squeeze through a small opening, pressure builds fast. Here's the unsettling insight. Volatility isn't a malfunction. It's how the system reallocates stress. Instead of defaults happening all at once, prices whip violently, absorbing imbalance through movement. That's why paper markets matter so much. Derivatives amplify flows far beyond the physical supply, creating dramatic price discovery before real-world scarcity fully asserts itself. It looks unstable because it is. And once this process starts, it doesn't reverse easily. It feeds on itself until something breaks, reprices, or resets, which brings us to the near future where the path forward splits. From here, the market faces two paths, and neither is calm. In one scenario, the surge pauses. Price drifts lower, maybe toward the psychological 100 level, shaking out leverage and cooling momentum. On the surface, that looks like relief, a reset. But notice what that would actually mean. Even after a violent pullback, silver would still be dramatically higher than it was before the breakout. Old resistance becomes new ground. Stability would be rebuilt on a much higher base. In the other scenario, the opposite happens. The market refuses to give back ground. Consolidation tightens near the highs, pressure builds again, and the next push clears the zone that just rejected it. If that happens, there's no recent structure overhead. Price discovery accelerates, not because sentiment is euphoric, but because there's nothing left to anchor expectations. Here's why uncertainty dominates. Both paths imply continuation, just at different speeds. There's no clean return to before. Momentum is already in motion. And the next decisive move won't announce itself quietly. It will form while most people are still arguing about what the last move meant. That leads to the final insight. Here's the insight that ties it all together. What you're watching in silver isn't about silver. It's about how stress leaves a system when it can't be contained anymore. Price didn't spike because everyone suddenly agreed on value. It spiked because too much pressure tried to move through something too small, too fast. That's why the surge and the reversal are inseparable. One created the other. Strength revealed fragility. Fragility confirmed strength. This is the mistake most people make. They focus on the high, the drop, the next target. But the real signal is that after everything, the market didn't snap back to where it came from. The baseline shifted, and when baselines shift, the story doesn't end. It deepens. Because the same forces that drove this move haven't resolved. They've only shown themselves. If you want to understand where this pressure goes next and what it means beyond a single chart, follow and stay with this analysis. The next chapter is already forming.